Hello. Hello, madam. Am I audible? Audible. Audible. No sound. Twinkle.
Yes, Gangadharan sir, you are audible.
Okay, okay. Audible.
Yes.
No sound.
My voice is not reaching you. Gangadharan sir, you are audible.
Okay, okay.
I think there is a lag of some seconds between my voice to reach you, I think. My voice is not reaching you. Gangadharan sir, you are audible.
Echo. Too much of echo.
I think there is a lag of some seconds between my voice to reach you, I think.
Echo is there. Audible.
My voice is not reaching you.
Oh, too much of echo.
I think there is a lag of some seconds between my voice to reach you, I think.
Echo is there. Audible.
My voice is not reaching you.
Oh, too much of echo.
I think there is a lag of some seconds between. Sir, am I audible?
Yes, you are audible.
Okay. Now it is not echoing?
No.
Okay.
Perfect.
Thank you.
Which paper, sir?
Effectiveness, leadership effectiveness, value-based leadership.
there is some echo at our end. We are just checking it now. Am I audible?
Audible.
You are audible.
Okay.
Echo is there.
So echo is also not there. There is some echo at our end. We are just checking it now. Am I audible?
Audible.
You are audible.
Hello. Hello.
इको येतोय इथे इको नाही येते तिथे इको येतोय का खाली
बोलिए
Hello. Hello.
ओके
I think now it is audible.
ठीक है
Sir, now it is audible, no, sir?
Hello.
Yeah,
Still
yeah,
it
you
is.
are audible.
Hello. Hello.
नाही इथे होतो इको तिथे नाही होते
अभी ठीक है आई गेस. वो यूट्यूब की वजह से था.
हाँ, ठीक है
क्योंकि
झालं,
इधर
झालं.
सेटिंग्स ऑडियो सेटिंग्स सही अभी वो यूट्यूब वही है चल रहा है ना उसी की वजह से वो दोबारा सुनाई दे रहा है आजा हो गया ठीक ठीक है
Okay, so we'll be starting in 2-3 minutes. Hello, Dr. Viramani. Sir, we can't see you. Can you put your camera on? Dr. Viramani, can you hear us?
Dr. Kritika are not able to see or hear Dr. Viramani.
Yes, sir. I am sending him a message.
But still from our end, if you can do anything.
I will just try.
Okay.
कुछ कर सकते हैं अपने एंड से?
Dr. Kritika, I think Dr. Viramani joined. Welcome, Doctor. Yeah, welcome, Doctor. Are you audible?
Thank you. Thank you. And good afternoon. And sorry for this slight delay because I had to change the computer.
Now perfect.
So can you hear us? Your voice
Yes.
is quite audible and you are visible as well.
Yes, I can hear you well.
Okay, so we'll formally start today's program. So, good afternoon, everyone. As a part of our members education series, the Institute has been organizing webinars on contemporary topics related to banking and finance domain for the benefit of professionals in this field. Today, on behalf of Indian Institute of Banking and Finance, I welcome you all for today's webinar on Budget 2025, New Initiatives to Drive Growth. Union Budget is a statement of a nation's aspirations, and India, being the fastest growing economy, looks forward to it for shaping the nation's policy related to economic recovery, sustainable growth, and technological advancements. Our guest speaker for today, Dr. C. Viramani, is Director of Center for Developmental Studies, Thiruvananthapuram. I now request Shri Visketan Das, Chief Executive Officer of Indian Institute of Banking and Finance, to deliver the welcome address and introduce our guest speaker for today.
Thank you, Dr. Kritika. Thank you, Dr. Viramani, for accepting our invitation and joining us. And I welcome you to this forum on behalf of IIBF and on behalf of all the banking and financial professionals who have joined this webinar. I welcome all the participants who have joined the webinar today to listen to Dr. Viramani. As one of the programs we generally conduct for our members and professionals to increase the breadth of the knowledge of the banking and finance professionals. And rightly said by Dr. Ketika, when we talk of budget, everybody wants to learn from the budget what benefits we used to have, particularly the salaried employed. So this time the salaried employed are very happy for the income tax benefits what do they get. But what are the long-term repercussions? If India wants to become Viksit by 2047, each budget will have its own repercussions in terms of allocation to resources to various productive and unproductive sectors, the borrowings, market borrowings, the policy measures. All these things will shape up the Indian economy when we grow at the rate of 6.5%, and we aspire to grow at the rate of 8% in future. To that aspect, I think all the bankers are eagerly awaiting to listen to Dr. Viramani that what the budget will have will reflect on the banking and financial sector in particular and in the economy as a whole in general. By Dr. Viramani, Director of Center of Development Studies, Thiruvananthapuram, is an acknowledged economics. Professor C. Viramani is one of the economists of the country who holds the doctoral degree from JNU, New Delhi. Prior to joining CDS, he had worked with eminent institutions like IGIDR, IIT Mumbai, and Indian Council for Research on International Economic Relations. His area of specializations are international trade, industrial economics, foreign investment, and labor market. He has contributed extensively in the areas of economic research and had served as a member of various committees, including the RBI's Empowered Committee on External Commercial Borrowings and the Standing Technical Committee of Experts responsible for reviewing Exim Bank's Expert Lending Index model, which forecasts India's exports. His recent research papers focus on diverse topics such as global value chains, trade patterns, trade policy, productivity, labor market outcomes, exports and job creation, and free trade agreements. His research has been extensively cited in Chapter 5, Volume 1, Creating Jobs and Growth by Specializing in Export in Network Products of the Economic Survey 2019-20, published by the Ministry of Finance, Government of India. Sir, we are very happy and honored to have you with us to share your views on the budget as well as the new initiatives which can drive the growth of India, not at the rate of 6.5, which is envisaged by RBI, but our aspirational growth at the rate of 8% and above, and how it will affect the banking and finance sector as a whole. So that I welcome you and I leave the floor to you, sir.
Thank you. Thank you, sir. And thank you for inviting me for this talk. Let me try to share the screen. Yeah, it is there. Is my screen visible?
Yes, sir.
It is visible?
Yes, sir.
Yeah, the PPT is visible, right?
No,
Not the
your
PPT.
folder is visible. All the
Folder
files
is
are there.
visible. Oh,
You have to open the PPT now.
yeah, just 1 second. Is this visible now?
No, please open the PPT. PPT is visible.
PPT, okay, only folder is visible, right?
Yes.
Yeah, just stop share. Just one second.
Kritika, you have made in the co-host, correct?
Yes, sir.
Share here. So share screen. Is it visible now?
Yes, sir.
Yeah.
Yes,
Yeah, sorry for that. Yeah. So, yeah, so let me now go to the topic of my discussion today. So it's a new initiatives for growth in the budget. So before getting into the topic as such, let me give the broad macro context and background in which this budget was prepared and announced. So the economy is on a relatively stable footing, showing resilience despite geopolitical challenges. So macro stability can be seen in terms of stable inflation rate. Fiscal health is good. There is fiscal consolidation and balance of payment. There are no major issues. So, but then the one slight negative news is the growth moderation, because in financial year 25, the GDP grew at 6.4%, which is lower than what it was the previous year, 24. 24, it grew at 8.2%. Inflation is stable and moving towards the 4% target. And there is strong growth in direct and indirect taxes. Fiscal deficit was 4.4% of GDP in FY25, which is lower than that was in the last year. Current account deficit is quite healthy, 1.2% of GDP. And because of increased net services receipt and growing remittance in the balance of payment, that has cushioned the rise in the merchandise trade deficit. So there is deficit in the merchandise account, but then there is surplus in services, and also there is a healthy remittance inflow that helped to manage the balance of payment situation. Foreign exchange reserves are healthy. Public investment has sustained capital formation in the last few years. And private sector investment is also picking up from FY22. Corporate profits to GDP ratio rose to 15-year high in financial year 24. So these are some of the macro background. Now, with respect to banking and finance in particular, what is the macro context? Gross non-performing assets declined to 2.6% of gross loans and advances. You can see that in the chart, that non-performing assets declining starting from 22 onwards, and it is one of the lowest level now, that is 2.6%. Capital to risk-weighted assets ratio, CRAR, is above the norm, which is 16.7%, which is above the norm. And profitability of scheduled commercial banks are increasing. Profit after tax increased by 22.2% in this year. And return on equity and return on assets also improved. You can see all this in the graph that is shown. All these indicators show an improvement. Credit dispersal of scheduled commercial banks is growing in double digits. But then there is some growth moderation in terms of credit in recent months. There is increase in the share of consumer credit in overall credit. Consumers' credit share in overall credit was 18.3% in FY14. That was 10 years back. Now it has increased to 32.4% in 24. And then another important trend is rise in non-bank financing options. Banks' share in total credit is 77% in financial year 11. Now, in financial year 22, it has reduced to 58%. That means the non-banking financial institutions' share is increasing. So these are some of the trends specifically with respect to banking and finance. Now, when it comes to global context, economic growth, global economic growth has remained steadily fairly moderate at 3.3% in 23, 3.2% in 24, and predicted growth of 3.3% in 25. So it's a moderate rate of growth at the global level. At the global level, inflationary pressures have been easing. Central banks in different countries have adopted more accommodative monetary policies. However, the risk factor is in terms of geopolitical risk index and world trade uncertainty index. Both increased in 24. There are some concerns, despite many positive news. There are some concerns. One concern is the recent growth moderation. It was only 6.4% this year. Last year, 8.2%. Inadequate growth of decent jobs. There are unemployment rates are not that high, but then the quality of those employment is a question. So decent jobs, there is not adequate growth. Slow export growth. That is another important concern. And a fourth important concern is geopolitical uncertainties, protectionism across the world in different countries, particularly in advanced countries, imminent trade war, that the tariffs are increasing. Trump is trying to disrupt the trade scenario, global supply chain disruption. So these are some of the concerns. So in this context, larger context, if you look at the budget, and before coming to that, let us look at this growth performance a little bit more carefully, the current year's growth performance, and compare that with the previous years in terms of growth across major components of real GDP. So real GDP's component includes consumption, private and government, and investment. Again, private and government. Then exports and imports. Exports contribute positively to GDP. Imports is a negative contribution. So when you look at the share of all these, how these different components have performed in this year in terms of overall GDP growth of 6.4%, we can see that private and government consumption expenditure increased. So it is mainly the 6.4% growth occurred supported by the consumption expenditure, both private and government. Investment growth, however, moderated compared to last year. If you look at the investment, gross fixed capital formation, last year it was 8.2%. This year it has reduced to 6.4%. Exports grew by 5.9%, primarily on account of services exports. Imports, however, contracted 1.3% negative growth. Therefore, net exports contributed positively to GDP growth by 1.7 percentage points. So suppose that this export did not happen this year, then our growth would have been 6.4% minus 1.7%. That is much lower. So export supported in the growth process, even though it is small, it contributed to the GDP growth. Now the important question is whether this growth moderation of a 6.4% from 8 to 0.8, more than 8%, is it due to cyclical factors or structural factors? There are a number of reasons to believe that this is due to cyclical factors. Cyclical factors means it is short-term, it's temporary. It's very likely that this growth will increase in the coming years. And there are some reasons to believe so. Look at the graph. In the graph, what is shown is the average growth rate in the current financial year, FY25, compared with that during the last 10 years, the average growth rate during the last 10 years. And we see that the growth rate in the current year, 6.4%, remain close to the decadal average. So it is not much lower than the decadal average. So there are reasons to believe that this might continue or it will not reduce further. And there are other reasons why to believe that growth may not reduce further. and it is temporary. One is that there are green shoots in capital formation. Union government capex, capital expenditure, is up by 8.2% in July-November 24. And capacity utilization in manufacturing is above the long-term average as per the RBI data. Private investment intentions increased to 2.45 lakh crore for FY25 compared to 1.6 lakh crore for FY24, again based on RBI data. So their investments are taking place. There are investment plans. And so therefore, it's likely that this growth slowdown is going to be temporary. It may be, it's very likely that growth will pick up, growth rate will pick up in the coming years. Now, what are the budget key takeaways? One is the fiscal consolidation. You can see clearly the fiscal consolidation. If you compare deficit trends, the deficit includes their fiscal deficit, revenue deficit, effective revenue deficit, and primary deficit. And you see all deficit indicators are showing a decline. Fiscal deficit has declined from 6.7% in 21-22 to 4.4%. The revenue deficit also declined significantly from 4.4% to 1.5%. So generally, deficit is declining, so there is fiscal consolidation. And which are the growth engines that the government schemes have tried to focus on? One is agriculture, MSME, investment, and exports. And there is certain continuity in this budget compared to the previous budget. One is the capital expenditure. Capital expenditure has been growing significantly. You can see that in the graph, the blue line which is going up, the share of total government expenditure, that is capital expenditure, that has gone up to 21.4% by FY24. And that trend, even though capital expenditure has not significantly increased, but it remains very high, 3.1% of GDP. There is continuing focus on MSME, which was also done in the last year budget. There is some focus on FDI, like last year budget, the insurance sector was opened up for 100% FDI. There is a continuity in terms of rationalization of taxes and tariffs. And the new thing that is introduced is a focus on regulatory reforms. So these are the main takeaways. Now, with respect to growth engines, on agriculture, there are several schemes that have been announced. I am not reading it out, all of them there. It is all there. Everybody can see in the budget documents, etc. There is Prime Minister's Dhan Dhanya Krishi Yojana, enhanced credit through KCC, Kisan credit cards, mission for cotton productivity, high-yielding seeds, Atmanirbharta in pulses. Similarly, there are schemes for MSMEs, credit schemes, loans up to 2 crore for the first-time entrepreneurs, manufacturing mission, measures for labor-intensive sectors, etc. And on investment, there is 50-year interest-free loan given to states for capital expenditure, subjected to the condition that the state will undertake reforms. Asset monetization plan for about 10 lakh crore. Urban Challenge Fund for 1 lakh crore, and so on. And there are some measures, schemes for tourism development. On export, there is Export Promotion Mission, Bharat Trade Net for giving information, market intelligence for exporters, National Framework for Global Capability Centers, GCC, warehousing facilities for air cargo. These are some of the schemes, major schemes that have been announced in the budget, which are meant for accelerating growth. Now, there are also reform focus. On financial sector, there is reform focus on speedy approval of company mergers. FDI limit for insurance sector increased from 74% to 100%. On tax reforms, as we all know, there is personal income tax reforms with a special focus on middle class. And then new income tax bill rationalization of income tax. Regulatory reforms, the approach is light touch regulatory framework based on principles and trust. High-level committee for regulatory reforms, Jan Vishwas bill. All these are some regulatory reforms. And there are also reforms on indirect taxes, which includes rationalization of customs tariff, import duties for industrial goods, removal of 7 tariff rates, and custom tariff reduction for a number of products. However, one of the challenge, particularly in the area of regulatory reform, is that implementation of several important regulatory reforms requires collaboration between the center and the states, because many areas in the regulatory reform area are in the purview of the state, like for example, land market, labor market, and also some of the ease of doing business measures. All these are things which the state governments have to undertake reforms. So a collaboration approach with the state government is very important for successful implementation of some of these reform programs in the regulatory field. Okay, now coming to this larger question of Viksit Bharat 2047. Now, the aspiration that India has to become a developed country by 2047, not Vision 24, Vision 47. So, for this, there is a need for sustained annual economic growth rate of about 8% for at least a decade. So Indian economy should grow at least 8% per year for at least a decade for this thing to happen. And investment rate should be 35% of GDP. Currently, it is 31%. That should go up to 35%. And non-farm jobs. Non-farm jobs means those decent jobs that, formal jobs should increase by 78.5 lakh new non-farm jobs should be created till 2030. So if you want to achieve this objective of developed country status by 2047, these are some of the very minimum requirements. 8% GDP growth, 35% of investment as a ratio of GDP, and a number of new non-farm jobs creation. Now, there are some global lessons about this, whether this is actually feasible or not. To understand this, whether this objective of achieving developed country status is feasible or not, we have to look at some of the history, some of the experience of other countries which have tried to do this. So, since gaining political independence after Second World War, the fact is that only a very small number of countries have successfully transitioned from low or middle income status to high income economies. Very few countries. Out of 101 middle income countries in the 1960s, only 13 countries could become a high income country by 2008. So from 1960 to 2008, if you look at, there were 101 middle income countries in 1960. Out of that 101 middle income countries, only 13 countries could become high income countries by 2008. This is as per the World Bank data. There is a very famous report by a very important report by a very famous economist who is a Nobel laureate, Michael Spence. So he published a report. It is called Growth Commission Report. So what he did in that report is that he studied these 13 countries which have become high income country, which were earlier a middle income country, but then became a high income country with an annual growth rate of all these 13 countries experienced an annual growth rate of 7% or more for 25 years. So continuously for 25 years, all these 13 countries experienced 7% GDP growth or more. And then the report identified a number of common success factors for all these 13 countries. One important common factor is openness to the global economy. The country cannot be protectionist and aspire to grow. That is not possible. So if you put barriers to trade, particularly on imports, then that country cannot grow. As per the experience of these 13 countries that have grown in the past and achieved high income status, all of them were open countries. Macroeconomic stability is very important. And high rates of savings and investment is very important. Market-oriented economies supported by capable institutions. That is a very important feature of all these countries. Competent and proactive governments. Urbanization and structural shift from agriculture to manufacturing and services. So these are the 6 major features of all these 13 economies that have transitioned to high income status from middle income status. So if India wanted to achieve, we are now a middle income country. And in 25 years or 22 years, if you wanted to achieve the status of high income status, we have to ensure that all these features are taken care of. We should be open to world economy. Import tariffs should be slashed. Second, macroeconomic stability. On that front, we are doing well. On the second front, stability is there. High rates of saving and investment rate should be increased to 35%. Market-oriented policies should be there. All these. So these are some of the critical ingredients for the country to achieve that growth. Now look at some of the, again, some important data here. So what is shown in this graph is, it is a ratio of 2 shares. So what is shown in the ratio, the numerator is the share of a country, including India, share of India in total world GDP. It's a share of India or China or Vietnam. We considered only 3 countries. Why Vietnam? Because in recent times, Vietnam has experienced a very fast growth rate, particularly on its trade front. So therefore, we include Vietnam. It is a very small country compared to India, but it achieved miraculous, super success in recent times. China's success, we all know. So therefore, India is compared with China and Vietnam. So what is shown here is, in the numerator is the share of each country in total world GDP. The denominator, the share of each country in world population. We know that India accounts for 17.5% of total world's population. India accounts for 17.5% of total world population. But what is India's share in total world GDP? It is about 3.5%. So this graph shows how that share, this ratio has changed over time for India and China and Vietnam. So you can see here some very interesting factors, because this is important to know whether we can achieve this high income status by 22 years. By 2047, is it possible to achieve? What is the ideal ratio? The ideal ratio should be 1 or above 1. Why it is, when it is 1, it means we are reached, we have a place in the world that is due for us. That means, proportionate to our population, we have income in the world economy. So when this ratio is 1, we have a place which is appropriate for us. If it is more than 1, it means that we are doing exceedingly well. So China has achieved that status 1 in around 2020. That means China's share in world GDP is equal to China's share in world population. Both are same. Both shares are equal. So that means they have reached at the right level in terms of their importance or power relations in the world economy. Where is India standing? If you look at India, it is below 0.2. We have to reach that 1 to become a high income country. Now, today, what is China's per capita income? Per capita income is $12,614. That is China's per capita income in 2023. To call one country as high income country, the threshold level of income is $14,000. So that means China is very close to that high income status, but still there is a $2,000 difference. So China in 2023, if you look at China's per capita income, India's per capita income in 2023, that is equal to China's per capita income in 2007. India's today's per capita income was equal to China's per capita income in 2007. That means we have that much 16-year, China is ahead of us, or we are 16 years behind China in terms of per capita income. In terms of this graph, that means in terms of that ratio, when if you look at our value, India's value now, that is just below 0.2 in 2023. If you look at that value now, China was in the same position in 2000, in the year 2000. Where India is today, China was there in year 2000 in terms of this ratio. That means basically it is possible. In principle, it is possible for us to reach that critical point of 1, which China reached in 2020. It is possible for us to reach that critical point of 1 during the next 22 years. Because China achieved it. China achieved it in 22 years, right? Or 23 years. China achieved it. So if China achieved it, it is possible for us to, in principle, it is possible for us to achieve the high income status or close to that by 2047. It is possible. But the question is, how is it possible? What ensures that? What needs to be done so that we can achieve that? The easy answer to provide is that with a China-inspired growth strategy, a growth strategy which is similar to the one that China followed. If we can follow that, India could approach high income status within 25 years. By 2047, we can be very close to, the high income status. It can be achieved. It is feasible. Now, what is the key success factor? The key success factor is accelerating labor productivity growth. Why that is so? Because you look at this. India accounts for 17.5% of total population of the world. But we account for only 3.5% of total GDP of the world. Now, why that difference? The difference is because our population is less productive. If each one of Indian citizen can produce more per person, that is what is labor productivity is. Then you can bridge this gap and reach that critical point of 1. That means it's a developed country. So if we can reach that critical point 1 or above, we become a developed country. The only way that can be achieved is if we can increase labor productivity, the productivity of labor. Now, how do you increase labor productivity? Of course, education is important, healthcare is important, skill development is important. But apart from that, there is one more thing which is very important. This is called the imperative of outward orientation. Now, this is a similar graph like the previous one, but one difference. Here, what we are taking is the share in world exports of goods and services. What is India's share in total world exports of goods and services? Divided by what is our share in world population. Our share in world population is about 17.5%, but our share in world trade is about 2% or 2.5%. So that means what? There is a huge potential there, because we account for such a very large country, accounting for 17.5% of world population, is exporting only 2% of world export, is accounting for only 2% of world export. Where is that remaining 15%? We can do that. Look at China. China has achieved something, not 1, but much above 0.6. Vietnam has achieved 1, right? That means Vietnam's share in world export is equal to Vietnam's share in its world population, its population. So their share in world export is equal to their share in world population. China's share in world export is still less than China's share in world population, right? So that means when we say that China is exporting a lot and they account for a very large share of everything that is traded in the world, don't take it as a surprise, because they are a large country. They are doing right things. So if they are exporting a lot in the world and they account for a very large share of the total world trade, that is nothing very surprising, because they account for a very large share of world population and they are proportionately, they are exporting. And they can even export, they have a space to export even more, because it has not yet reached 1. They can export even more, because ideally, if you have to account for your export, if it has to be export share has to be equal to your population share, it will be 1. Now your China's export share is less than its population share. For Vietnam, it is equal. So that means that China can still export. So whatever China is doing is not something unfair or unexpected. It is not very surprising. What we are doing is surprising. Why we are not exporting? Despite the fact that we are such a big country, why we are not exporting? That is the surprising thing. China exporting a lot is not at all a surprise for me, because they are a large country. They account for a large share of world trade. That is quite natural. Now, in India, we have a belief that we have a large domestic market. This is a very wrong notion. Why? Because yes, we are a large market in terms of the number of people. But a market is not determined by the number of people alone. If a large number of Indian population are very poor, they have very limited purchasing power, then can we say that we are a large market? We have 17.5% of world population, but we have only 3.5% of world GDP. That means 97 or 96% of world market is not in India. 96% of the market that is available for Indian companies is not in India. That is outside India. So if we are cut off from that market for whatever reason, we are not doing a wise thing. China didn't do that. They realized that their major market is not in China. Their major market is outside China. So they opened up. They exploited the opportunities which are available outside. But our case, we have this belief that we can grow based on our domestic market. But our domestic market size is very small relative to the world market. We are just 3.5% of the world market. The remaining 96% is outside India. So that means based on a strategy that is based on only domestic market, we cannot achieve this high income status. And not only that, there is evidence that households, firms, and government, all of them are consuming based on debt. Household debt is increasing. Firms' debt is increasing. Government debt is also increasing. Now, how long you can consume? You can continue this consumption just based on the debt. So, domestic market is not a guarantee and it cannot be the basis or source of your growth. You have to open up. India is still not a large country in terms of purchasing power. And the way forward is to expanding outward orientation through participation in what is called global value chains. So that is what needs to be done, because world exports market cannot be captured unless we are part of this, what is called global value chains. Now, what is global value chain? Global value chain means products are manufactured not in one country. Parts and components are procured from different parts of the world. We call this global supply chains or global value chains. So, for example, when you buy a mobile phone from China, not everything is made in China. Only some assembly of a mobile phone or some certain parts only is made in China. The remaining parts are imported from all other parts of the world. So that is what is called the global value chain. So we have to be part of that global value chain. If you wanted to exploit this huge market which is outside India, and it is not a small market. And they always policymakers say that, the global economy is not doing well, the world economy is not doing well, therefore we cannot grow. We cannot say that as an excuse. Why? Because we are not saying to do a lot. We are saying that do proportionate to our size, our population. That is the unexploited potential, right? When we are exporting, our share is only 2% of the global trade, but our population is 17%. Even if the world economy is flat, even if the world economy is not growing, still there is a lot of scope for India to expand its export, because that difference, 2% of world trade export and 17% of the population, there's a huge difference of 15%. So if we can increase that share, which is our due share in terms of our population, then that is a big opportunity that can be tapped to achieve this goal of Viksit Bharat. Without that, if you just focus on domestic market, it's impossible to achieve. That is the lesson that has to be learned from Chinese case. Now, the same thing can be shown whether you talk in terms of goods export. You can divide, you can look at total exports into goods export or services export. On the left-hand side, it's goods export. And you see that gap, India-China gap, is mostly in the goods export. In services export also there was gap. It is not that India is doing better than China. In the last year, 2023, India and China is doing relatively equal. But before that, even in services, China was doing better than India in terms of their relative share. So, and it is in the goods that is where the main gap between India and China exists, and that gap needs to be bridged. And there is a potential, irrespective of whatever is happening in the world economy, by using the right type of policies, India can achieve that, unexploited potential. Now the question is, now this is true in terms of all indicators of international outward orientation. Look at international tourism receipt. If you look at the tourism receipts, now look at the tourism receipts that Vietnam is getting relative to their population. Relative to their population, they are getting a lot more receipts, international receipts from tourism. China is also getting more than India. Look at what India is getting, very small. So that is again another potential. And FDI share, the total FDI share relative to our population. How much FDI are we getting relative to our population? When you compare that, Vietnam and China gets far more than India. So in terms of all these indicators of our economies, outward orientation, we rank very low. That need to be changed. That mindset change needs to be there. We cannot be protectionist. So that is the important thing. And this is what is showing in terms of graph, in terms of policies, like how India is charging tariffs, how protectionist we are. We are one of a country in the world which imposes the highest import tariffs. In the recent budget, in the current budget, there is a welcome departure. There is a understanding that we have to reduce tariffs to become part of this global value chain. So a number of products, the tariffs have gone down for the current budget. In the previous budget, last year budget also, there was some initiatives that were undertaken. But in the current budget, we can see that there is a significant reversal of the earlier thinking. That now we have to cut down tariffs. For a number of products, the tariffs have gone down, have been reduced, and that process need to continue. And how much time is it a time
You can continue. Continue, please.
I can continue? Okay.
Yes.
Yeah. So please tell me when I have to stop.
Okay, sir.
Please tell me. Yeah. So when we are talking about global value chains, I just wanted to explain what that concept is in a little bit more detail. So when we talk about global value chain, there are two concepts. One is what is called backward GVC. GVC means global value chain. Backward GVC integration, and the other one is forward GVC integration. It is important to understand this difference. Backward GVC integration basically means we are importing parts and components from other countries, then adding value, and then exporting back to some other country. Like, for example, India is now exporting mobile phones. So when you export mobile phones, we are importing these components from other countries, mobile components from other countries, assembling the mobile phone in India, and then exporting back. That is backward GVC integration. In automobile also, we do the same thing. When we export cars, many auto components are imported. Some of the auto components are procured domestically, some are imported. So this type of involvement is called backward GVC integration. Forward GVC integration basically means, like, for example, India export iron ore or cotton or cotton yarn. We export cotton yarn to Bangladesh. Then Bangladesh, using Indian cotton, manufacture clothes or apparel and then export it to EU. So that is forward participation. So one is backward and the other one is forward. Now, policymakers always think that if you create domestic linkages for our industry, it is a good thing for us, right? Creating these domestic supply chains or domestic linkages is going to be good for us. Now, when you are part of the global value chain, you are not creating so much of domestic linkages. What you are creating is you are creating international linkages with other countries. On the other hand, domestic linkages means that you are procuring your parts, components, etc. internally from the country. Now, which one of these strategy gives us a better, opportunity to grow and achieve this high income status? Now, that depends on how much gain we get from global value chain participation as opposed to manufacturing everything domestically. If you create value chain domestically, we get something. If you are part of the global value chain, we get something. Which one is higher, right? So this is like comparing, you can think about a situation in which you get one full pizza, but it's a small pocket pizza. The pizza which is the size of a coin. You get one full pizza, which is size of a coin, versus you get a slice of a large pizza. So one situation is that you get a full pizza, but the full pizza is equivalent to a coin. And then you get one slice of a very large pizza. Now, what is that large pizza? Large pizza is the world economy. So if you get a slice of that large pizza, that is going to be more beneficial than you get one full pizza, but it is equivalent to the size of a coin. It's important to understand this. Why? Because look at this. Look at this industry. This is a comparison between India and Vietnam. You know that Vietnam is a very small country compared to India. It's a fraction. Their population or GDP is a fraction of India's. Very small country. But look at in this industry. This is the industry called the computer, electronic and optical products and electrical equipment. I'm just taking this as one example. Now, what is shown in this graph on the left-hand side, it shows a measure of the involvement of the country in the GVC, backward GVC. Backward GVC, there you see there is a number 49.8 for Vietnam. For India, it is 25.4. Let me explain what that number actually means. That 49.8 for Bangladesh, for Vietnam means that when they are exporting from their country of this product, computer, electronic and optical products, 50% of what they export, 50% of the value, actually they imported from other country. Only 50% is their domestic value addition. The remaining 50% was imported from other country, which is embodied in what they are exporting. Because when you are importing parts and components which are needed for manufacturing computer, that value is there in your final product. So that value is 50%. That means 50% was foreign value added for Vietnam. The remaining 50% was Vietnam's domestic value added. Vietnam is labor and capital got the remaining 50%. For India, that number is foreign value added is only 25%. We got a higher domestic value addition. That means 75%. For India, the domestic value addition is 75% per unit of whatever we exported. We got a 75% domestic value added. Only the remaining 25% was import part, foreign value added. Now, that is what happens per unit of goods that we export. But does that really matter? What really matters is the aggregate size of the pie. That is what is shown on the right-hand side. On the right-hand side, you can see DVA. DVA means domestic value added in that industry in terms of billions of dollars. For Vietnam, they got $28 billion by doing this. By exporting this product, they got $28 billion in aggregate terms. That is domestic value addition. India got $8.6 billion. Now think about this. Such a small country relative to India is able to create 3 times more domestic value addition from this product than India. Now, how is this possible? It was possible because Vietnam was part of and heavily integrated in the global value chain for that industry. But India is cut off. We force our firms to procure parts and components domestically by imposing tariffs on intermediate goods. So in that process, what we lose out is the world market. So this is what I said. Vietnam is getting the slice of the large pizza. One slice of the large pizza, which is 28. India is getting full pizza or 3/4 of the pizza, but it's a small pizza, right? It's a pocket-sized pizza. That is only 8.6. Vietnam is getting one slice of a very large pizza. So this is what is important. This is based on actual data. There is no manipulation here. There is no no econometrics here, nothing. It's a simple plain data. So this is what we are losing out when we are not part of the larger world economy. So this is the way forward. So if we can get this done for a large number of industries, then that is the way forward. We cannot depend only on our domestic market because our domestic market is still very small relative to the world market. It is only 3.5% of the world market. The 96% is outside India. So that part we need to keep in mind. And so then people will say that, yes, China could do that, but at that time was different. Now the time was changed. Now AI has come, so many different things, tariffs are there, Trump started imposing tariffs. So China could do it because things were better at that time. It was different at that time. But is that really true? Now what we do is look at these, what you call the GVC products. GVC products means basically those products where there are global value chains. So let us say that these GVC products, which includes, for example, electronics products, automobiles, computers, mobile phones, all these products where production is manufactured by different companies in different countries of the world. Like, parts and components are manufactured in different countries. Assembly takes place in some country. That is what is called the GVC products. In the case of GVC products, if you look at the pattern over a long period of time, what has happened in many years back in these industries? If you look at that, there is a model, a phenomena called wild geese flying pattern. Wild geese flying pattern means wild geese fly in orderly ranks, forming an inverse V shape, just like airplanes fly in formation. Just like the airplanes during Republic Day parade that fly in a V shape, inverted V shape. You can see that type of a shape. I will show you very quickly. So what is shown here is, this is something that an economist in Japan, Japanese economist called Akamatsu, has found out long time back. That is true even today. So look at this pattern. So what is shown in this graph is world market share in these GVC products. Like, what is the share of different countries in the world market for the GVC products? You look at that beautiful graph, inverse V shape for Japan. Japan had a world market share above 5% in 1962 in GVC products. They went up, they expanded in that sector, and then they reached a peak of 25% by mid-80s. And then after that, they started descending. Their share started declining. Now, when their share is declining, you can see other, what you call follower geese. Japan was the lead goose. The other countries are the follower geese. They entered in the market. And you see Korea, Malaysia, Singapore, and later China. The China is the red graph. You see that as Japan is withdrawing from these GVC products, China entered. So when one country is exiting, another country entering. This is the pattern. Now you can see that China has already reached its peak. What Japan achieved in 1985, China achieved in 2016 or 18, that peak. It started descending. You can see the red graph going down. So their share is declining. So that is where another large country in Asia has a potential to enter. And which is that another large country in Asia? It is India. So we have that potential. And we have already shown that it works. Look at the example of mobile phones from India. Mobile phone exports from India in recent times. India's mobile phone exports in recent times increased many times. Earlier, India was importing all mobile phones. We had a huge trade deficit in mobile phones. But under the PLI scheme, we provided certain incentives for mobile phone assembly, manufacturing in India. Big companies like Apple, Samsung, all of them entered in Indian market. Now, after that, you see that our trade deficit has become now a big surplus. We stopped importing mobile phones, but we have become a major exporting country for mobile phone. But what really worked there, apart from the PLI scheme, what really worked there was the trade policy. Indian trade policy allowed these companies to import mobile phone components free of cost, free of tariffs. So the tariffs on imported components were slashed because Apple, when they entered India, they said that we wanted a duty-free import of components, which government allowed. As a result, we have seen the result in that case. Now, if we can replicate similar experience in other industries, particularly in electronics and electrical machinery, etc., we can replicate what China did. It's not something that is impossible, no matter AI and all might have come, but we can still get our due share in world trade. Our due share in world trade is 17%, nothing less than that. Why our due share in world trade is 17%? Because we account for 17% of the world population. So if we improve our productivity, we should get a 17% of world trade. Nothing can stop us. And nobody can say that we are doing something unfair. And from that point of view, nobody can blame China also that they are doing something unfair. What they are getting is less than their share in world population. So I don't think it is impossible to do it. And now look at India. Where is India in this market? This is the red line here is India. You can see there is some slight increase in recent times, mainly because of the mobile phone export. And but look at Vietnam. Vietnam is the green graph. Look at the sudden takeoff for Vietnam. But Vietnam is a small country. It has a limit on how much it can export for the world market. It has a limit. So it cannot replace China. Vietnam cannot replace China. The only country which can replace China is India. For that, we needed, first of all, import tariff rates for intermediate inputs should be made zero or negligible. During the last few budgets, there is an attempt to do this. The other issue is that issue of inverted tariff. Inverted tariff means the tariff rates on parts and components are higher than the tariff rates on final products. So when you import a final television to India, you pay, let us say that you pay 10% tariff. But the parts and components which are used for manufacturing a television, you pay 15% tariff. So if that is the case, will anybody manufacture television in India? We will not, because you have to pay 15% to the parts if you want to manufacture television in India. If you want to buy a television, you only have to pay 10%. Then it is better to buy a television or import a television rather than manufacturing. This is a serious problem. That problem is called a inverted tariff problem. And that issue is there. And in the current budget, there is a welcome initiative. There is an attempt to address this issue. So for many parts and components in the current tariff, the tariffs in the current budget, tariffs have been reduced. In the previous budget also, this initiative was taken, but earlier, few years back, the idea was that we should increase tariff to protect the domestic industry. But now there is a welcome departure that you can see, and tariff inversion is something. This is the last thing which I will show. I have made some calculation to understand where tariff inversion exists in India. And so tariff inversion is nothing but a ratio of input tariff to output tariff. Like, if the parts and components used to make a television attract 15% tariff, but a final television attract 10% tariff, then your tariff inversion is 1.5. That means 15 divided by 10. So we can calculate this, and we have seen that, for many products, there is a tariff inversion problem in India. Like a manufacturer of communication equipment, you can see that for many of them, tariff inversion coefficient is above 1. Above 1 means inputs for manufacturer of communication equipment has a higher tariffs than the final product. In that case, we import the final product rather than manufacturing it here. That makes more sense. We need to correct it. We have to make this ratio below 1. Similarly, manufacturer of electrical equipment, there is a inverted tariff problem there. Manufacturer of machinery equipment, inverted tariff problem there. Manufacturer of electronic component, consumer electronics, magnetic optical media, computer, there is an inverted tariff problem there. The only product industry where we do not find an inverted tariff for many years, except one, was the transport equipment. So what I wanted to say here is that generally the focus of this budget, people have been discussing about this income tax, relief for the middle class. Now, of course, that is a very important one. It has its long-term, short-term implications as well as long-term implications, because when people get more income, disposable income at their disposal, they may either consume it, or they may save it, or they may invest it. So whichever way, it is positive for growth. That is true. It ultimately, how much gain it will lead to depending upon the marginal propensity to consume. So if the marginal propensity to consume is high, which is now considered to be something like a 0.6 to 0.7, then it will have a multiplier impact. But that alone cannot lead to a major impact on growth. That is a short-term fix. As a short-term fix, it is a good thing. It gives that boost in the short term to get out of this growth moderation. That will help. But in a long-term sustained growth, what we need is the regulatory reforms, which this budget has tried to mention. But the challenge there is many of the regulatory reforms are in the purview of the state government. So unless many of the reforms which are possible at the central government, many of them are already done. Now, whether it is industrial delicensing, GST reforms, or other reforms in the area of agriculture, certain reforms in the FDI. These reforms, many of them at the purview of the central government, many of them have been attempted. But then the remaining area, there is a lot of regulatory cholesterol in the country that need to be removed for improving the efficiency of the economy and improving the labor productivity so that we can achieve that high income status through competitiveness, through improving competitiveness, particularly export competitiveness. But if that has to happen, state government has to come on the board. They have to undertake reforms. So central government has to collaborate, and then there are incentives for state government to undertake reforms. So that is very, very important. In the regulatory field, lot of that is in the domain of the state. Land, labor, agriculture, some of the municipality, local government related problems, all these have to be solved by the state government. So that is one thing that need to be done for the long-term growth. The other one is that we should try to be part of this larger global economy. Our outward orientation has to go up significantly if we have to achieve the vision 2047. With this, I will stop here. Thank you.
Thank you, Dr. Brahman. It's wonderfully presented to the viewers and to the IIBF also. And very well said that if you want to get developed, you have to be part of global value chain. You cannot be a protectionist and aspire to become a global player. And particularly your example of Vietnam, how it is gaining against the India, and how our big industries also, they want protection. Perhaps we need to be more competitive than to become more protectionist. When you see that, and your particularly deliberation on the state government, coordination between state and central government is superb. Perhaps maybe like a government created IFSC at Gujarat, we can have centrally located some of the industries where it can be more export oriented. It has to be centrally monitored, irrespective of the states or irrespective of the local bodies. Perhaps a coordinated effort will be required. Thank you. I think the viewers are benefited. Over to Kritika.
Thank you, Dr. Viramani. And this was truly indeed a wonderful session. I'm sure our participants have also found it quite interesting. And in case they have any questions, they may now raise their hands in the chat option.
There are some questions on the chat.
Yes, so we'll take few of them.
Yeah.
I can see many hands raising up. So Mr. Uttam Mehta, I am allowing you to talk. You can talk and discuss your doubt with Dr. Viramani. Mr. Uttam Mehta?
Am I audible, ma'am?
Yes, yes.
Yeah, first of all, thank you for this giving this wonderful opportunity to get the insight of the budget and the way forward to be developed country 2047. So apart from the government initiatives and industrial perspective, I just wanted to what will be the role of the financial institutions to cater this requirement to grow, because faster settlement of the payment and lot of documentation part, which is indulge slower down the processing value for bank and NBFC. That reform need to be carried out. So my humble request to sir, if we can put some light on the reform area specifically to banking and NBFC sector, sir.
Right. Yeah. Yeah. So yes, because the financial sector is a part and parcel of the story. Because if without a very efficient banking sector that do the financial intermediation efficiently, so basically the idea is that the more productive firms and more productive industries should get more allocation of resources. So the credit allocation should go to the sectors and firms which are more competitive, which have the potential to be competitive. So the reforms which are needed to ensure that, like the banks are in a position to finance firms and industries which has a potential to improve their competitiveness and do better, particularly in the world market, needed to be thought through. So it's a very, very important part, because unless these financial constraints are eased, this will not work. So banks have to play a very, very critical role in this process. So that is very important. And for that, one thing that many people talk about is that whether bank consolidation, some banks coming together, merging, because there are big advantages of scales. Like rather than having a large number of small banks, it is always better from a financial efficiency.
Doctor, we lost your voice.
Consolidation of smaller banks to become bigger and therefore more efficient, and then do this financial intermediation role more effectively.
Okay, I think
Thank you, sir.
yes. So now we'll take another question. Mr. Sandeep Narayan Sinha. Mr. Sandeep Narayan Sinha. Are you there with us? Yes, you can discuss your doubts, sir. I think Mr. Sandeep is not able to.
Yeah, you take somebody else,
We
then
will
later.
take somebody else. Now, Mr. Sunil Vani. Mr. Sunil Vani. Can you hear us, Mr. Sunil Vani? If you have any question, you can share it with Dr. Viramani.
You unmute yourself, Mr. Sunil.
Yes, we have added you here. You can unmute yourself and you can share your doubt.
Madam, no questions. Sorry.
Okay,
Okay.
no
No
problem.
questions.
Mr. Prabhu C.
Thank you, madam.
Yes.
Thank you, madam. Thank you, sir. And sir, Mr. Veermani, sir, it's a very good insight you have provided on the Viksit Bharat 2047. That only my doubt is about it. As we are planning for the central government as making the budget, and we are making that schemes and other things. Unless there is as India is a federalist state, that all the many states have carried out the subsidies as well as welfare schemes welfare subsidies. Inappropriately, they are carrying out the schemes, and almost as on date is almost 200 million beneficiaries have been directly benefited from the that were called one way or other way of direct benefit by state governments. In this situation, as you stated very, we have to increase that industrial labor productivity when you are things. How we can restrict that states economies for carrying out this measure to restrict them to by avoiding that restrict them to the debt to the GDP. Borrowed debt to GDP, reducing it, and so that the desired objectives achieved. Sir.
Yeah. So that is a very important question about federal system. So one is that we have to operate in a cooperative federal setup where reforms are very important. Yes. Yeah. So reforms are very important, and for which a state has to play a very important role. And then, as you rightly pointed out, these are what we call sometimes freebies. There is a competitive offering of freebies by political parties. All political parties are doing, both the central government as well as state government. It is not only state government doing, also central government is also doing in various forms. Some of them are justified because you need genuine support for people. So that is true. But then there are many things which are wasteful. So there is a need for rethinking this entire approach of giving these type of freebies on a competitive type of basis by different political parties. The only way I can think a way out there is that, there should be some kind of code of conduct there that everybody should, in the larger interest of the country, if every political parties come together and create a code of conduct in terms of giving these freebies, some kind of limit on that by how much each government can give is one way. The other way is that otherwise it will lead to a situation which is fiscally unsustainable. Fiscally unsustainable. And the problem is that every rupee that is spent on particular purpose X is the money which is not spent on some other purpose Y. Now, suppose Y is more important, like, providing education, healthcare, etc. is more important than giving freebie. Then, education and health will suffer. So therefore, it is important that there is some discipline in this aspect by all political parties. Some arrangement has to be made for that. That is one thing. The other one is that suppose that is not possible, is not going to happen, that all political parties are not willing to come together and arrive at a consensus on this. Then the other option is wealth creation. So if for example, a good example is Tamil Nadu government. Now, Tamil Nadu government, we know that they, whichever political party that comes, they give a lot of freebies. But one good thing that is happening in Tamil Nadu is also wealth creation, right? There are a lot of automobile industries, a lot of new industrial, investments are taking place there. Now, the freebies are then becoming financially sustainable to a certain extent. So, the freebies will become financially sustainable only if simultaneously wealth creation happens. Now, wealth creation will happen only if we leave many aspects of the economy to the private sector. So there is again reforms needed for there. We have to disinvest public sector in areas which are not very strategically important. Public sector to hold. All other things need to be privatized. Then only the wealth creation happens, and then with the wealth creation, a part of the wealth can be distributed in the form of freebies. So unless there is one way is a consensus have to be arrived at. Also simultaneously there should be this effort for creating wealth creation so that, financially, the governments are in a position to support. Now, suppose that the labor productivity increases, in the country, like the way I said. Now, productivity increases, what does it mean? That means every person, working age population, every person gets a higher income. That is what labor productivity means, right? Higher wage rate. So when people improve their income through higher labor productivity, then there is no need for freebie. So if we are able to grow through wealth creation, there is no need for anybody to get the freebie. Freebies will disappear then, because freebies are needed when the population, large fraction of the population are poor and they are in the informal sector and they are poor. They earn very little. Then there is a political support for freebie. But when people are rich, they are employed, they do not have to depend upon, then they don't have to depend upon the freebie. So this growth, labor productivity improvement through reform is also a way of getting out of this freebie culture.
Thank you, sir. So we'll take one more question, and I'll request Ms. Meenakshi Sundaram C to share her doubt with Dr. Veeramani. Ms. Meenakshi, are you there with us?
Can you hear me, madam? Can you hear
Yeah. Okay.
Yes.
Okay, we can hear you, sir.
me? Sir, actually, in case of this backward GVC and the whole value chain, if the design component is not happening in India, and suppose say for example, if the mobile phones export has been increasing, but in Apple mobile phone it is written as designed in California but assembled in India. So that such being the case, if profit base erosion, profit shifting is happening, because 80% of the profit is being shifted out of India. And such being the case, then whether India will be stuck as a middle income trap wherein we import inputs, assemble, and again export. But in the net, when we come to net exports, our contribution to GDP, again, it will be stay in the where it is, because we don't have that exactly in that whole value chain. We don't have a big share of that profits, which actually improves our exports.
Yeah. Yeah. So very good question, and very relevant in this context. Let me explain this to you. So this is one concern that many people raise. I had some slide to discuss this, but I left it. But let me, because you asked this question, it is important to explain. So what is here we are trying to do, like in the case of mobile phone, for example, in the GVC literature, there is a concept called a smile curve. A smile curve means it is like a U shape. You can imagine a U. And in the U, the bottom part of the U curve is what is called assembly, like, where the value added per unit of activity is the lowest. So assembly is the bottom part. And then when we go towards the left or right, then more higher value added activities within each industry emerges. Like, which may include doing R&D, marketing, designing, all kind of after sales services, all kind of things are in the two sides of the left and right sides of the smile curve, the U curve. So generally what happens is that the countries, when they enter into GVC for the first time, they enter at the lower part, which is the bottom part of the U curve. This is exactly what China did in the 1990s. They just assembled everything for the world market, in their export processing zones. And people en masse migrated from rural areas to urban coastal cities. And in the export processing zones, they were doing just this assembly. The companies like Foxconn, employed tens of thousands of workers just to do the assembly for big companies like Apple, Samsung, and all that. Then what happened is that when you achieve a particular level of activity within the country, it can be in the form of just assembly. Generally, what happens is that an ecosystem develops for moving up in the value chain. That means to move up in the left and right side of the value chain. And this has happened in the case of China. So what happens is that when multinational companies come and do business with the local companies, MSMEs, and all that, there is a lot of this learning that takes place. And, the ecosystem develops over time. For these countries to move up in the smile curve and get a higher value added activities. And also over time, with that, you create national champions, your own brands. Like China now create brands for almost everything. There is Chinese brands on mobile phone. They make their own, they have their own brands. Now, earlier, they did not have any homemade brands. That homemade brands came only because they got into this assembly-based type of value chain in the initial stage. And with the time, learning by doing and, scale expanding, these type of economic activities emerge with the time. Now, in India also, we have a very good example in the automobile industry. Now, in the 80s, when Maruti came first in India, initially, the entire Maruti car was a joint venture between Maruti and Suzuki, and the entire car was assembled in India. Like, almost all auto components and everything was imported from Japan and assembled in India. Now, after that, what has happened is that these auto ancillary industries developed in a major way in India afterwards. So, initial entry was in the assembly. At the lower end, their value addition is low. But with the time, the ecosystem developed, auto ancillaries came up, and some of our auto component industry, firms have become, world class, and they become highly competitive internationally. Now, all these dynamics happened with the time. So we can replicate similar type of experience elsewhere. In the case of mobile phones, we have done a study in our institute in Trivandrum recently to find out what is the kind of value addition that is actually taking place in the mobile phone. It is not true that it is only assembly. Initially, it was only assembly, but now we have seen that the share of domestic value added in total value of output in mobile phone, earlier, some 5 years back, it was about 8%. Now it has gone up to 22%. That means the mobile phone has established connections and linkages, backward linkages with some of the other sectors in India, including services sector, professional services, many other service sector, and also some of the other manufacturing sectors, they have established some linkages. Some 20% is 22% is the domestic value added in mobile phone now. So even if you give a 4% in the PLI, as an incentive, still we gain in terms of an aggregate value added. We still gain from it, and this 22% will increase further in the coming years because the ecosystem will develop. And one more thing, India is now home for 50% of the global capability centers, what we call GCC. Global capability centers are the back-end office of the multinational companies. So what they do is that they do all these services for the manufacturing companies, including R&D. Doing R&D in India is more cost-effective now than doing R&D in advanced countries. Why? Because we have an English-speaking, skilled workforce at a relatively lower wage rates. So they are shifting some of these services activities, high value added services activities to developing countries. India is now home to 50% of the global capability centers that have been established. So with the time, all these can develop, but we need an entry, and that entry could be at a lower level. But over time, you can move up in the value chain. So that is the strategy that would work.
Thank you, sir, for addressing all these queries of our participants. And due to paucity of time, we have to restrict our question and answer session at this point. I now request Dr. K. Gangadharan, Director Academics of Indian Institute of Banking and Finance, to conclude today's webinar with a vote of thanks.
Respected CEO, Indian Institute of Banking and Finance, our esteemed Chief Guest, Professor C. Veeramani, similarly, the participants from different institutes and other organizations attending this webinar, and my colleagues in IIBF, friends. It is my privilege and honor to extend a heartfelt vote of thanks in the final conclusion of this webinar on the topic Budget 2025 New Initiative to Drive Growth, actually organized by IIBF. Before moving to my task of expressing the vote of thanks, I would like to sum up the key messages given by Professor Veeramani in touching with the budget actually that we have witnessed the past week. Actually, at the time of presentation of the budget, actually our finance minister proclaimed that the budget is actually a developmental, passenger developmental flight, having four segments, four engines and 10 segments of growth. And these four segments are four engines are mainly, we can see that the reforms actually created. The reforms are there. Reforms are actually providing the pathway. And mainly the fuel for the passenger product is actually the reforms that actually carried out to the government. Then target is actually the Viksit Bharat 2047. And there, the supporting rules and regulations are very, very corroborated as the supporting factor for accelerating the movement of the flight. And moreover, one more statement she has made from the budget speech that from the Telugu poet, that G. Apparao, that a country means its soil. A country means its soil, a country means its people, not the soil. In a Telugu poem by highlighting that she also mentioned. So here also the message given by C. Veeramani actually see that we have to focus on the strength and caliber and competence of the people to achieve the things that actually China gained around 3 or 4 years back, from 2006 to 2023. That is around 17 years. They have tried their level best to attain the target. So similarly here also, the important benchmark highlighted by Veeramani highlights that if we also try on this level, definitely the Viksit Bharat will not be a hidden. We can also attain, because here the biomarkers are very fruitful for us. And if you are ready to tap and utilize to the level, definitely it is possible to attain that benchmark. And here he maintained that the challenges of especially the regulatory cholesterol, actually it is very relevant for a country like India, because the federal setup, we are having different states, having different land resource, different potential, the skill, potential resource, everything vary from state to state. So a common rule to utilize all these resources in a profitable and efficient manner will automatically enable us to improve our value chain, especially GVC, because different states are having the skill content is totally different. Similarly, resources are also different. So we have to nurture such areas with certain policies and inputs. Definitely, we can improve our GVC value chain. So that will be an attempt also. So the regulatory cholesterol attempt must be there as part of the policy matters of the government. Similarly, also mentioned that 8% GDP in a year, then 35% investment as a rule of GDP. Then also providing 75 non-lakh farm jobs. These are the three criteria actually highlighted for achieving 2047 Viksit Bharat. I hope that the policies and program actually highlighted by the government through different budgets for the last 8 years is one or other providing a channel for achieving this type of achievement. And similarly also mainly that the reducing of tariff, the macro stability, high rate of investment, similarly urbanization, macro oriented policies, all these are now government is actually implementing step by step with the target of attaining the 2047 goal. And moreover, it is also predicted that by 2047, one paradox he mentioned, about 17% of the global population and only 3.5% of GDP. I hope that this actually falls out itself. But it is hope that with the improvement of the skill empowerment of the country, by 2047, it is expected that around 29% of the whole labor force will be from India. That projection is also calculating. 29% of the global labor force will be from India. That also will be a good advantage for a country for attaining the target and also to supersede China also. Then similarly, the imperative outward orientation is also a right step that we can consider. The budget also providing a lot of incentives for improving this type of lubricants for promoting the production of agriculture, industry, MSME, etc., where different types of incentives are given, because through MSME only we can boost our export also particularly in the certain identified products that is actually creating in the GVC area. So similarly also the decision taken by the government by incorporating all the benefit extending to especially the recent the tax concern itself is, I think that is a lubricating force, because actually the reduction in the tax concern up to 12 lakhs will be providing a boosting itself. Even the newly recruited people in the government service will be taken as advantage. Around actually the last figure, around 87.5 million field actually filed income tax in the last year, 87.5 million. And moreover, this current year it is estimated that around 63 million people are availing the tax benefit under the new regime. And here also we can that those who are having the income slab up to 25 to 50 lakhs also will benefit a minimum 1.1 lakh as a benefit. And definitely I think that all this will be supporting one way or other to the consumption bundle of Indian economy, and that will be providing some boost for all this type of production. And hope that if it is channeled properly by considering all the regulatory aspects and also the inward and outward orientation, and also at targeting at the global perspective, treating China as our next best competitor, and the population is also very high. Definitely, I hope that there is a scope for attaining the Viksit Bharat by 2047. There is no doubt that if we are ready to work on that lane, if the policymakers, planners, and people are on the same lane, definitely, I hope that we can attain that. That will be the some sort of the implication given by the indicators given by the presentation by Professor C. Brani. Sir, I would like to enter my task. So first and foremost, I would like to express our deepest gratitude to Professor C. Biramani, Director, Center for Diversity, Tirunelveli. He is my friend also. So on behalf of IIBF and on behalf of this entire the IIBF family members, and also all the academics and business and financial people assembled to this virtual platform to listen the talk on this particular topic. And we hope that his deep analysis, expert perspectives, and also valuable insights into the budget and its implications have actually enriched our understanding and given us much to reflect upon. Sir, your expertise has truly added immense value to our today's discussion. Thank you, sir. Thank you very much. Then, on behalf of all of us in this virtual platform, I express my deepest gratitude to Mr. Vishwakethan Das, our Chief Executive of Indian Institute of Banking and Finance, for gracing the webinar with the esteemed presence and valuable insights. His leadership and dedication continue to inspire the banking and finance community as a whole. And sir's contribution to today's discussion enriched our understanding of the budget impact on the finance sector. He has also motivated and also organizing different types of this type of program to motivate the entire banking and finance community. Then again, I take this opportunity to express my sincere thanks to my colleague, Dr. Kridika. She has actually coordinated this program by ensuring maximum participation from all the BFSI community. Similarly, also I take this opportunity to extend my sincere thanks to our HR and the admin department for also providing maximum publicity and priority and significance to reach this message to almost all people and fraternity in the banking and finance sector industry. Then also extend sincere thanks to all our colleagues in IIBF. And above and all, the first and foremost, actually, I would like to extend my appreciation and sincere thanks to all the esteemed participants for your active engagement and also thought-provoking questions to make this session very live and active. Thank you, sir. Thank you and all for making this session very live and very an academic exercise of IIBF. Thank you. Thank you, one and all.
Thank you.
Thank you, Dr. Binaman. And for the benefit of all the participants, this total lecture will be uploaded in our social media. Subsequently, you can also see and tell your friends to also see. It's a very good deliberation on budget. Thank you. Yes, Dr. Kridika.
Thank you, sir.
Thank you.
And we are now officially ending this webinar. Namaskar and all the best to everyone.
Thank you. Thank you, Dr. Binaman.
Thank you. Thank you.